So welcome, everyone. Thanks for coming to our panel. Today I've got an amazing panel joining me, and we're finally talking about something more interesting than just why tokenize assets. And it's going to be about collateral markets, so that's pretty good. My name is Anastasia. I'm head of growth at Defactor. We are a real-world asset tokenization company that tokenizes assets, also launches lending and borrowing tech for projects that are growing in the space. And we are also the founding member and the backing company behind RWA.io, which is a ever-growing data platform for all things RWA. So happy to stay in touch. Today, I've got Peter with me, who is an expert in the bond markets. We got the opportunity to work together on the tokenized bonds, so that's pretty cool. Bobby as well. I've been watching him over a year now, growing the durian farms out of Malaysia. So happy to see you in Hong Kong, finally. And Jackie and Bridget, I just met today, and looking forward to learning more about Asset of Finance. And of course, Avalanche Labs, everybody knows you, but happy to see what you guys have in store for collateral markets. So I guess just to kick off, maybe a quick 1-minute intro, how you ended up stepping into the Web3 space, and what you guys are focusing on right now. I think maybe ladies first.
Thank you. So I'm Bridget. I'm the co-founder and CEO of Assetto. We are building the yield infrastructure for the stablecoin economy. And I used to work in traditional finance for the previous more than a decade of my career. I worked with guys like Morgan Stanley, Standard Chartered, UBS, all the boring ones. And then for the previous 3 years, I started looking at crypto, doing a bit of venture investments as well as liquid strategies. And I found that tokenization actually is something that could really have a use case after that mass adoption has come for stablecoins. So basically, we see assets and capital as the two flip sides of a coin. So once the stablecoin, the volume of stablecoin grows, there's going to be a natural demand for real-world assets tokenization. So that's why I decided to basically quit my job, be reborn, and then join this field. So looking forward to having this conversation with all of you.
And sorry, and when was that you guys founded?
This year.
This year, okay,
Yeah.
so you're the new one in the Web3 space.
Yeah,
I think that deserves a round of applause, guys, come on.
Welcome
to the space.
Assetto is up and running for 6 months. I think we're already one of the top tokenization service providers in Hong Kong. So,
excellent. Yeah. Happy to have you here. Peter, over to you.
Yeah, thank you very much. And hi, everyone. Linkscap, company I represent, is a conventional investor in real estate-backed assets. In our case, these are real estate secured debt in Europe. And for us as the investment company, we are looking forward to understanding where the world is moving. And we see a lot of, let's say, potential. It's a theory still to be proven, and we'll talk about it later as we go. But basically, we want to get exposure to crypto assets and to create a bridge, which we actually did. We implemented one project, a token, which we minted, and it has been already sold to multiple investors, up to date since the middle of the summer, so it kind of works. We believe in that an asset mass that has accrued in the crypto space is looking its way into the real world, or let's say maybe even sometimes back into the real world for diversification purposes. And we're basically establishing this with our product.
Excellent, thank you. And in the middle of the summer, I think for European sales, that's also pretty impressive whilst everyone is on vacation.
Yeah, that's true.
Jackie, over to you.
Hello, thank you for inviting me to this panel. My name is Jackie. I'm the head of Hong Kong at Ava Labs. A bit about my crypto journey. So after graduation, I spent 2 years' time at Deloitte, Australia. And then I quickly get bored and then came back to China. So I was looking for a job. And then I was browsing the job site, looking for a VC job. But in China, due to regulations, you can't say crypto. So there's a job post as a fintech VC. So I applied and got the job. And then on my first day, I realized it's a crypto fund. It's called IOSG Fund, IOSG Venture, so in Shenzhen. So everybody is talking about Ethereum. So I didn't know what's Ethereum back then, back in 2020, but I started learning and then build up my faith. And then after IOSG, I moved to different places, and my most recent experience is as a senior listing manager at Hashkey Exchange, and then now I'm in Avalabs. So something about Avalanche. So Avalanche is a high-performance blockchain platform that is lightning fast, very low cost, and fully customizable for enterprises' needs. So we have this very innovative multi-chain structure that is very optimal for tokenizing real-world assets. And actually, for RWA, we went way back. Back in 2020, we have been starting experimenting the tokenizations of the private equity with KKR. And I have a lot more to share, especially this year with the boon of the RWA. We have a lot more use cases to share with some of the biggest industry pilots and enterprises in the later section. But I don't want to take too much time here. Thank you so much.
Yeah, hello guys. I'm Bobby. I'm the VP and co-founder of Dr. Durian. So I think my journey towards this business started from my financial background, right? An interesting story. 3 weeks ago, my father just showed me the plan I previously sold to him. Like 12 years is his investment plan, making a loss of $3,000, right? And then I was like, oh wow. And I think this is the reason why I left the financial industry as well, because a lot of product that I sold previously, I would say it's slightly over-promise but under-deliver, right? And I don't want to continue in that industry. Also, I also went into the crypto industry like 4 years ago, right? I think everybody into this crypto industry, they want to get rich. But I got poorer instead, right? Because there's just so much scam project out there, right? So when the opportunity comes about, combining real business, which is Durian, right, and real profitability, king of roots, into a crypto space project, I started this project, right? Because as much as we like it, I think that regulation is going to be here to stay, right? We cannot always live in a world where crypto is just selling based on dream and hype. It has to be backed by real revenue and real asset, right? And why we started Durian? Because it's very easy to understand, right? I think Asia is crazy over Durian, right? Like in China, in Hong Kong, a lot of them just love Durian, right? And it's very easy for people to understand. So what we do is very simple. In Dato Durian, our token, unlike crypto token, is backed by two important things, right? It's fully backed by business share, 100% of the business share. And the most important thing is that our land is held in custody by a trustee company in Hong Kong. Why is it important, right? Because a durian tree can actually grow up to 80 years. That means it's a very long-term profit, right? Like even if we are no longer around to manage a farm, the trust company can appoint a new durian farm company to manage the business. I think that's very important. We want to create a project that is not just 1-2 years, but for longevity. Thank you, guys.
Yeah, that's probably the most exotic real-world asset that I hear about. And it's interesting that it is out of Southeast Asia, because I think that region is really picking up on tokenized assets. The only question is, do you have durians in your office, I wonder, as a snack?
We have fake durians.
Fake durians.
I think if I bring a durian to office, I think I'll go to the police station.
So today we're talking about collateral markets. I guess just to kick off with something a bit basic for those of you that are just coming here learning about tokenized assets. Jackie, I want to address this question to you to speak about some of the unique advantages of bringing assets on chain. Why are we talking about tokenized assets? What is it bringing to us, to the capital markets?
Yeah, sure. So we all know how the traditional capital markets work. It's very slow, no transparency, and then involves high operational costs, and then there are a lot of intermediaries involved. So what Avalanche does here is to flip the model on its head by sub-second finalities, thousands of transactions per second, and then 24/7 global markets. So that makes perfect sense for tokenizing real-world asset on-chain, no matter it's equity, credit, real estate, or hedge fund, giving like people fractional, always-on access. And in general, like bringing asset on-chain, real-world asset on-chain will make them more accessible. But when it comes to like asset issuers, like what are the elements that you should look for when choosing a blockchain to deploy on, or like the advantage of like what Avalanche can offer is that I think first of all is volume and liquidity, because that's the most important reason why people wanted to tokenize their asset on-chain. You can always deploy on Avalanche C chain to access like massive liquidity. So recently we have been really focusing on like cultivating high quality assets and bring that onto our ecosystem. For example, the BlackRock Builder Fund, Apollo Diverse Credit Fund, Franklin Templeton Benji Fund, and also I have to mention the Janus Henderson AAA CLO fund, which gives you an extra, like more exposure to senior credit beyond the money market fund. So we partner with Centrifuge and Grove to not just by wrapping the ETF, but also actually bringing the actual credit strategy onto a on-chain native format. So that has been very successfully reducing the intermediary costs, enhance the operational efficiency, and give more access to global capital markets and capital allocators. And yeah, so, and also besides the supply side, we're also very focused on the demand side by helping, by having robust distribution channels to bringing a lot of institutional buying powers and volumes to our assets. And we're very lucky that we are actually the second largest blockchains in terms of AUM on the BlackRock Builder Fund. And then besides, you can launch on C chain, which is an EVM compatible chain. We're actually the only blockchains that can help enterprise to build like customizable purpose-built L1s. So these are the flexibility and compliance concern that a lot of issuers having right now, because like these L1s that we build for enterprises, they are fully sovereign with its own rules. So it can be a private chain, can be a public chain, it can be permission or it can be permissionless. You can have like geofencing, you can have a KYC, AML built into the protocol level, at the chain level, and also sharing the safety and interoperabilities that really empowers customizations, control, and jurisdiction rule right at the chain level. I can share an example that we did in Singapore. So with Grab and Alipay. So if you go to Singapore right now, you can just scan using your Alipay Plus to scan the local Grab QR code to pay the local merchants seamlessly with the on-chain FX market and 24/7 global settlements. So Grab built an L1, Avalanche L1 just for this because like due to compliance, they only allow Singaporean to join as a validator. So only the Singaporean that passed through the KYC with a Singapore IP can join the network as a validator. And then also the case that we have with Toyota, they built 4 L1s on us. They just released 2 weeks ago their white paper to bring vehicle finance, regulators, insurers on-chain in a unified digital platforms. And basically, we're the only option for them to manage permissions while sharing the interoperability. And then the third very important thing would be safety. So we have pretty good track record in terms of safety for that. Thank you so much.
Thanks, Jackie. I think these are really practical examples for sure. And I think you mentioning transparency and risk, that's definitely something that is very applicable to the collateral markets. We've been providing tech for lending and borrowing, so constantly dealing with things that are essentially transferable from TradFi with the margin calls and things like that to DeFi, and essentially combining now in this tokenized asset space. And touching upon risk and transparency, I wanted to talk to Peter next with your expertise in the real estate market, especially around the debt instruments. Remember 2008, hidden collateral. It wasn't really clear to a lot of investors how to interact with it. Do you think assets being brought on chain is going to help prevent for that type of hidden collateral building up and essentially causing the next bubble that we're all going to suffer from?
And we will. Ultimately, this is how the mindset of human beings is set up, I guess. But the short answer to your question, it depends. It depends on the context. In 2008, it's about the speculation and lack of regulation, and somebody trying to, let's say, lever up via financial intermediaries, multiple exposures to the same asset. Now we know this, so people are aware. Can you replicate this in real-world asset? You certainly can. And I think this is one of the problems that market needs to solve. In a sense that there's so much stuff out there generally that people don't understand how it works and what's the exposure, what are the risks. If you own something via real-world asset, it doesn't mean that you can get hold of it at the end of the day, because you need to create that link. You, Bob, you were saying, and I was asking you before, right? So I own a unit of something. But what if something goes wrong? Ultimately, big money will be asking these difficult questions. How can you procure that the jurisdiction is good enough to ensure that your rights as an investor will be exercised with the due care, right? All these little things, they matter. And some jurisdictions, which I'm not an expert in Asia, in Europe, let's say we operate in Luxembourg, that gives like instant and good quality world standard investor protection rights that a lot of funds are based there. But again, Luxembourg, let's say, is good for Europe. And we work in Europe. For us, it's a good match of the jurisdiction and regional, let's say, presence. Luxembourg and having an asset in Singapore or Malaysia, what's the point? It's about the local jurisdiction. So the token itself, the real-world asset location versus the local jurisdiction, combination of the two is what's required. But it's a wild, wild west. I heard the other day that somebody, I mean, this is wild, a real-world asset being an asteroid. I mean, it's great. It's a funny story, right? And people can make this decision to make that investment. It's fine, as long as they're aware. Yeah. And the question is, it's not regulated completely. So whatever happened in 2008, you cannot regulate for that in the crypto world. It's everywhere. We know that, right? So it's about people understanding what they're buying. Generally, investment community understands much more, simply because, people saw this information accrues. You take advantage of previous mistakes. I hope at least big money should, and they seem to do so. So in the real world asset, this is a great case, in my personal opinion.
You like durians?
Yeah, well, it's understood. Business concept is understood. Jurisdiction is solid. And we are big fans of these things as well. We try to implement this in a similar way in Europe, where jurisdiction proper, the structuring itself is proper, because real-world asset is a token, just a tool. Yes, it works. Yes, it's fine, but it's not. It's just the piece of the whole, the chain, and it has to be solid on each and every step.
Yeah, and I think to your point about user education, like we really are all working together on the delivery of that message to the wider masses. Like crypto, I don't know how many of you have been in crypto for the past 2-3 years. It's been the same group of people hopping between different events, meeting each other again, right? I think real world assets and tokenizing it, I don't really like the term RWA. I think it's just assets, right? Like we are the borderline between the crypto and the degens and the actual massive industry of capital markets, right? And I think the sooner we educate a lot of, I'm not saying that it's us who is educating, we're all learning today, right? But the sooner we get that acknowledgement that, yes, it's just the tools, the TradFi is still TradFi, the capital markets is still there, and now we're just going to operate in a bit of a different manner. But the user adoption, I think, is key, and we do need to make it very simple for people to start interacting with digitized assets and with tokenized traditional assets. And speaking about collateral, I think it's collateral calls and things like that are all manual and rather slow at this point, right? In terms of bringing the assets on chain and making it a bit more like an instant settlement type of process. Bobby, what do you think are the barriers to that becoming essentially a mainstream?
Sure, thank you, Anastasia. I think you mentioned a very good point about education, right? I think before I talk about collateralized, I think that education is going to be very important, right? I think everybody said that RWA bull is here, right? But if you look at the RWA analytics, I think more than 90% are private credits and treasury bills, right? Like these are not, these are RWA, but it's not a real RWA in my opinion, because anybody can just get a bond, get a private credit, any account, right? It's not something that is not accessible to them. So I believe that education is very important at this stage, is because, right, like in RWA space, crypto is here to stay, whether we like it or not. JP Morgan has just launched their own coins. PayPal has just accepted 100 over payment methods, right? Like banks are opening up to all these rails, right? But the thing is that, how can we get people like my father or like my uncle to understand about crypto? When I try to talk to them about BTC, when I try to talk to them about Ethereum, they don't understand what it means. Like even they will not understand something, they will not invest in something they don't understand, right? But when I talk to them about durian, how to buy durian, we sell durian, and then we distribute the dividend back to them, it's something that's easier for them to understand, and they're willing to try, right? And that brings us to the point of collateralize. Because fundamentally, I think a token should an investment product should always protect an investor interest, right? And collateral is very important. So how do we do that, right? In Dato Durian, it's very simple, like I mentioned just now. When we tokenize the farm, our land is being held in custody by a licensed trustee in Hong Kong, right? Why Hong Kong? Because Hong Kong has the best trust law, right? And this gives investor confidence, right? Because like investor want something that's guaranteed. Like yesterday and today, there's many people approaching Dato Durian booth. They ask me, hey, I just want to invest something safe, right? I want to make sure anything happens, I can get back my capital. I think this is where collateralize is very important. In the traditional crypto world, there's literally no asset, no nothing at all, right? So there's many ways we can do about it. In TradFi, using property, using collateral is a very common thing. But in crypto world, it's almost close to zero in RWA space, right? So I think it's very important for every RWA project to consider their asset, to consider their holdings into making a form of collateralize that can gain investor confidence.
Thanks, Bobby. And I think it's interesting. Well, you're right. It's a lot more tangible when you talk about tokenized durian farms, right? But I think the point you mentioned about cross-border, for example, for traditional assets like T-bills, not everybody had an interactive broker account to interact with them. So I think tokenizing assets and bringing them cross-border to those jurisdictions where some of the local retail investors, they couldn't actually access some of these products, but they had heard of them because they all watch the news and they know the big capital markets. So I think maybe that's kind of also partly why that all started with private credit and with treasury bills, because it's easy to understand, but it wasn't accessible across like all of the jurisdictions around the world. And now bringing in a lot more exotic products into the tokenized asset space, I think is definitely making our space a lot more interesting. Hopefully the users will be a lot more accustomed to those type of asset classes. But it all comes down to regulatory environments, catching up, the legal side of things being a lot more straightforward. So I think let's talk about the barriers for the regulations. Jackie, what do you think needs to be worked on and how to approach that from the regulatory point of view?
Yeah, so I think for regulations, like one of the main regulations, like barrier that we have right now, as Peter and Bobby just mentioned, is about involved in the RWA section is really about like whether the tokenized bond or real estate or like equity is fully equivalent to the traditional counterpart. I think this is the main issue that all of the regulators and like industry pilots are like tackling it right now, and whether like the jurisdiction, some of the jurisdiction right now lacks like clear rules to define the investors' rights when it comes to like whenever there is a dispute or like a fraud. And it's a bit easier for standardized like bond market like T-bills and repo markets, but it'll be a bit more tricky when it comes to stocks or real estates. What if like Tesla denies it for the tokenized asset like ownerships on chain? And we're lucky to have like NASDAQ already like file like a proposal for the SEC for the settlements outside of the US like NASDAQ stock markets. And then the Hong Kong government has already made it very, very clear that they do not encourage stock to be settled outside of the Hong Kong stock market. So we have a lot to work on in terms of that. And then another thing that I want to touch on is the KYC and an AML efforts. I think we already have a lot of solutions for that. For example, like we take the compliance KYC to the exchange level, where in Hong Kong we have the OSL, the hash key, that KYC people at the exchange level, and then we also have solutions that brings the compliance or KYC to, for example, the token level. For example, like we work with Skybridge to tokenize 250 million of the hedge fund onto Avalanche. They use a token standard core ERC 3643 that is very, very regulator friendly and allows for like very, very audit proof But Avalanche here is taking it to another level by taking the KYC and then taking the compliance right into the chain level, right into the protocol that adapts different jurisdictional rules. And we've been seeing that this bring into action by Wyoming, the first US state issue stablecoins, launching on Avalanche, spendable by Visa card. And then that really is a successful cases for bridging the Web2 and then Web3 world while navigating the US regulations. Where also we have, for example, like the Toyota case that showcase the blockchain prototypes to that brings car vehicles on chains, that showcase like how standardized tokenization stations can harmonize differences. And when it comes to like Denaries, so it's an on-chain stock protocol platform that launch on many chains, but they launch an Avalanche L1 with us to act like a DTCC in like a financial markets to support the omni-chain liquidities across different chains because they trusted us to take the compliance to the chain level when dealing with security, because you have to take extra care when dealing with security while ensuring the interoperabilities.
Thank you, Jackie. And I think I want to switch the discussion a little bit more towards collateral markets. And I think one of the biggest pain points is liquidity, as I think everybody would agree. My next question would be to Bridget. And before I ask that, I actually wanted to see how many of you guys had borrowed or lent to someone based on a digital asset collateral. Has anyone in the audience today interacted with digital assets? Not necessarily tokenized assets, because that's obviously a very new industry, and I don't assume a lot of you would have had that experience. But maybe like borrowing against your crypto, like anybody had that? One person had? Okay, great. More? No? Okay. Well, I guess maybe something to learn for all of you guys from Bridget and the interaction of tokenized assets with collateral markets. How do we bring more liquidity? How can we ensure that we can design a tokenized asset collateral system in such a way that it keeps liquidity in the market?
Yeah, thanks a lot for the question. It's actually a very important question because for the past few years, I think a lot of RWA projects are trying to crack this, but none of them have really been able to scale this. So basically, if you look at Buildo on among the 3 billion TVL, the collateralized and lending market is like below 1 million or something. It's just not, it hasn't grown. Similarly, for similar efforts done by the Apollo Acrid Fund and the other ones, I think in the DeFi market, still it hasn't scaled yet. So one of the major problems is permission, the permissioned mechanism. So basically, for the DeFi protocols, they themselves need to be KYB'd with the asset issuer, as well as the potential liquidators that may come in to liquidate the collateral. So this would actually kill the underlying decentralized liquidation mechanism, which is actually the essence of the DeFi lending protocols as of today. So the DeFi protocols have been trying to welcome more RWA assets. So they're building new versions, for example, Aave v4 or Horizon. And Morpho itself, it's a segregated vault basis. So they're doing it as well. But still, for the permissioned mechanism, I think there's still another difficulty, which is the liquidation mechanism, as I mentioned. So permissioned mechanism is one thing. And also, they would need to be able to monitor the real-time price movement of the tokens. So for native digital assets, it's fairly easy. The Oracle is good at capturing real-time transaction data to determine the price at any given time in the 24-hour, 7-day cycle. But for RWAs, as we know, the price of the RWAs mostly are fed via an oracle that extracts data from off-chain. So this would create a problem for liquidators or for the lenders, simply because they have very limited information as to where the collateral assets are actually trading at. So without this information, it's almost impossible for liquidators to really come in. And it's very possible that at the day when the price is finally fed to the oracle and brought on chain, the borrower may already have defaulted. So that brings us to the third layer of the problem, which is the liquidity or the subscription and redemption cycle of the underlying asset. For example, some of the private funds, they're trying very hard to get to a monthly subscription and redemption window. So with monthly subscription and redemption, if the collateral assets, the price depreciated significantly on day one, if any liquidator really comes in who have been KYC'd already, they come in and take the collateral, they would need to wait for 29 days to be really able to redeem the underlying asset they have seized. And at that day, the asset may already have dropped to zero. So this whole liquidity gap has made it very difficult for RWAs to really be utilized well in the collateralized lending market. So I think the other way to think about it is that, firstly, market makers are absolutely a must for any of these situations. So when we talk with curators, we always would bring in our own market maker to be the last resort liquidator for the RWAs as collaterals. And secondly, we need to really think about term funding. I think for the existing DeFi protocols, it's always very dynamic funding. But then for institutional grade assets with lower liquidity, we need to think about term liquidity. So we need to match the liquidity from the demand side with the supply side in order to really make this work. And it's great that guys like Avalanche are working with the institutional demand already. So for guys like Grove or other asset owners or allocators on chain, they could have a flexibility in regards to liquidity. For example, they could give out the loan for against collateralized RWAs for like 1 month or even 6 months or 1 year. And more, they're growing more like traditional financial institutions. And in that way, I think it's a better way to really bridge the gap instead of trying to cut up the liquidity of illiquid assets, but you try to really bridge illiquid assets with term funding. So that's a way that we could work around this. Yeah.
Thank you, Bridget. And I also always talk to projects whenever we launch lending pools for them. There are always two must-haves, right? As you mentioned, the data source, so where the pricing is coming from. So obviously, as you mentioned, there's most likely coming from oracles, but also it could be coming from the traditional finance source, like the estimate of the real estate pricing and basically everything that you would use in the traditional finance to estimate the asset value. And then secondly, of course, the liquidator. And a lot of times, especially for the assets like real estate, the liquidator would be just that project themselves for the beginning, because they would just buy back that tokenized asset at a discount in case of any default. But that's the beginning. How do we scale and go further when there's more liquidity? I think that's the pain point. And I wanted to ask you, given your experience with the tokenized money market funds, and I think you recently also launched a partnership with EXIO, which is an exchange license in Hong Kong. So of course, exchange is always bringing a lot of volume into our space and retail interest as well. Do you see money market funds as an ideal sort of collateral for tokenized asset lending? Or is there any other asset that you would find that could be easier to deal with in terms of liquidation and pricing, price source for the asset?
Yeah, so money market fund, I think the biggest problem is that the yield is not that high. So for example, the money market fund that we do, the APY is 4.3%, but then the borrowing rates on average is very close to that line. So it's very difficult to really do a positive carry looping strategy on money market fund. The good news is that some of the ecosystems are actually subsidizing this in order to boost the TVL of money market fund or T-bill backed on lending. So we are aware that one chain is actually subsidizing the lender leg to an interest rate, a borrowing rate of 2 to 3%, just to make this work. So if any of you are doing that, you could give it a go. It's free money, basically. But then it's not sustainable, obviously. But I think at the back end, what we're trying to do is to try to plug in these, see whether it works, and then we could work on more economically rational collateral. For example, fixed income funds. So if you invest in really high grade and low duration on fixed income funds, you could get an APY of 5 to 6% perhaps. And then you do a looping strategy on an interest rate of 4, you could still get 1 to 2 spread with each loop that you get into. But obviously, you need to look out for any a gap risk along the way. But that's something that we could look at, I think. Just try to do very liquid, well, particularly daily liquidity strategies, and then do looping. And one thing I want to mention is that if someone has a very great market analysis capability on interest rates, you could always do looping, because that's what traditional bond traders do. They may bear a negative carry just in order to take profit, to make profit based on their view on whether the rate would go up and down. It's very similar to what Bitcoin or Ethereum traders are doing. So if more institutional investors with real views on fixed income come in, everything can be looped.
Thanks, Bridget. And I guess going from money market funds to fixed income products to now, Peter, back to you, since you're an expert on bond products as well. Now looking into the future of other tokenized assets, money market funds, fixed income, bonds, what's next? What do you think in the 5 years we will see as tokenized assets that are growing faster than others?
Yeah, well, we'll see. I think that ultimately, listen, if you take something that is anyways available through another, entry point, being that a bank, you take, some kind of reputable name that does whatever, credit or money market fund, and it's accessible through a bank versus it's accessible through a token. It's a matter of the margin, who gets it, where, and how they kind of, it's not. I think it's kind of not that important for overall the industry. This exists anyways there. What's important, and this is where I see, in my view, the value, and I think this is where we're heading, is the easier access to a local knowledge. So you can access some interesting investment opportunities elsewhere via crypto, and if it's properly structured, then you just have it readily available. So this is the value. Other things being equal, and other things being equal, meaning that it has to be anyways properly evaluated, and et cetera, et cetera, et cetera. But fundamentally, crypto does not have any boundaries, so the world becomes a marketplace. And I think that it's very important to, let's see how it works out, but my bet is that the platforms that are currently onboarding pretty much any, and the easiest starting point is to onboard something which is anyways available, known, like a credit fund, and offer this to the market just to, fill in the shelf of products, right? Ultimately, there will be specialized platforms who will be taking the role of being due diligent agent to see what seems to be good and what seems not to be good. Like what's the role of the investment bank in fundraising activity? That they just do due diligence on the client and they say, we validate this client, and the investors go and invest, because investors don't have always privilege of being able to do due diligence. So you have these platforms popping up here and there that will ultimately shortlist and specialize in finding qualitative, interesting products somewhere else, and not just taking what's available, throwing it in. It's like, wow, we do it 24/7, all that kind. It's important, but it's not the only thing that is important. Fundamental value creation is important. So I think we'll have specialization. Now industry tries to kind of find its, industry players try to find its place And at the end of the day, we'll see some, interesting names, I'm sure, that will be doing this role. And this is the link. And this is the deployment of the capital in the very productive spot somewhere else, because there's no boundaries. This is exciting.
Yeah, and I think the point that you mentioned is actually quite dependent on jurisdictions as well. And I like how you asked also Bobby earlier about his experience in Asia, and you're obviously the expert in the Luxembourg jurisdiction and the Swiss ecosystem. But next question, Bobby, is for you to wrap up the panel about exactly this. Like, we are building so many counterparties, not just the due diligence and the legal and the regulatory framework, not just the tech companies that are helping to tokenize the assets and then obviously bringing them to exchanges for more liquidity and distribution is the #1 important step. Comparing Asia, I guess, to the rest of the world, Bobby, what do you think is here in Asia as an advantage for pushing this industry forward with collateral markets and tokenized assets leading the space?
I think Asia is a very unique opportunity just because obviously Asia, the wages causes compared to other countries is very different, right? Like, so there's a lot of like small business opportunity. Let's just take an example, like for example in China, right? Like we have been approached by so many small to medium-sized businesses, right? They can be agriculture, they can be like a profitable business or food and beverage business, but they do not have an opportunity to get a bank access loan because like what Peter mentioned, right? Last time in traditional world, banks will take a lot of like DD, right? And there's only a certain risk appetite, they can get a loan for, right? But there's a lot of businesses in Asia that really need help, right? And literally really need help because even in Hong Kong previously, I heard that the RWA seminar, right? Sorry for being just so direct, but I think a lot of like regulatory or exchanges in Hong Kong, they're still focusing on the big boys, right? Big funding, big TVL, big lending. But I think Asia is more than that, right? Like there's so many things that you can explore tokenizing. Whether is it like us, like agriculture farms, right? Like durian, for example, or we have been approached by a pig farm, right? Produce plenty of pig, profitable, but banks just choose to ignore them to give them like a loan as well. So in my opinion, like Asia has a tremendous opportunity just because we have many businesses that was not made available to the public for tokenization or for investment previously, right? And if we do it well, do it right, and like what Peter mentioned just now, I think there must be a people to look at all these projects and recommend to investors because there's a lot of projects, but there will be probably a lot of scam as well. So I think people must tell out like the exchanges, like for us, in terms of we are good in agriculture, we got to access good projects, like profitable projects, and bring them on board so that investors get a chance to invest in all these kind of opportunity. Yep.
Thanks, Bobby. And I think for us at Defactor, for example, I'm based here, but we're a global company. And from the perspective of all the projects that we've been speaking to, I think the main, struggle is really, well, #1, how do you prove to your users that the asset exists? Then to the point that Peter made earlier, who has done the due diligence and onboarded everyone properly so that the institutional investors can interact, right? And then now to your point, in terms of actually being that small and medium enterprise that also wants to touch tokenized assets, but maybe doesn't have the capacity of BNY Mellon and all the big guys that are bringing in tokenized assets into their ecosystems, what can they do to actually properly onboard relatively quickly in a smooth way and then also attract the wider investor community to their particular, renewables asset plant in the middle of Guangdong, or any farm in Malaysia, or anything that's a little more exotic and from Latin America or everywhere else. And in that sense, I think, thank you all for bringing something into the space and working on something particular. I think every industry is just, the success is measured basically by everyone being focused and laser focused on one thing that they do really well. And I think in our overall tokenized asset space, I think we are quite privileged to have so many counterparties now compared to at least back 3 years ago when I started working in this industry. Now we're a lot more mature. We have a lot more these laser-focused projects that are doing exactly their asset class the way it should work for their users. And hopefully in the next 5 years, we'll all come to a bigger industry. Of course, probably still a fraction of capital markets, but hopefully a step towards being of that size. Thanks, everyone, and back to Andrew.
Thank you.
Thank you. Thank you.